Lately, unusual movements have been observed in the US stock market. Today, we'll delve into the reasons why large-cap stocks outside the S&P 500 index are outperforming the market and discuss the resulting investment strategies, all based on a securities firm's report. Surprisingly, over the past 3 months, large-cap stocks not included in the S&P 500 index have shown significantly better performance than the S&P 500 itself. These stocks have risen by an average of 50%, while S&P 500 large caps only saw an 8% increase. The key lies in the performance difference depending on whether or not they are included in the S&P 500 index. So, why is this unusual phenomenon occurring? We can point to 4 main reasons. Expectation of S&P 500 index inclusion. The first reason is the expectation of being included in the S&P 500 index. Large companies can be incorporated into the S&P 500 at any time. In fact, before their inclusion is decided, these stocks tend to outperform the market by more than 10%. It's somewhat similar to how trainees waiting for final selection in an audition program receive more attention, wouldn't you say? Increase in special rebalancing. The second reason is the increase in special rebalancing. With the recent rise in mergers and acquisitions, stocks are frequently being removed from the S&P 500. This naturally increases interest in which stocks will fill those vacancies, and the expectation of new stock inclusions fuels their price increases. Leading sectors and solid earnings. The third reason is the leading sectors and their robust earnings. Think about the hottest sectors in the market right now: cryptocurrency, AI infrastructure, AI software, cybersecurity, and some financial stocks. Companies in these sectors are driving up their stock prices with strong earnings to back them up. Good earnings naturally lead to rising stock prices, right? Strong demand from individual investors. The last, and perhaps one of the most crucial, reasons is the strong demand from individual investors. Institutional investors, especially passive funds, are pulling out of the US stock market due to macroeconomic uncertainties, such as tariff issues. However, individual investors are different. They are actively flowing into the market, chasing the upward momentum of individual thematic stocks. In short, while institutional selling pressure is suppressing S&P 500 constituent stocks, individual investors are finding hidden gems outside of it and fueling their rallies. So, how long will this phenomenon continue? And how should we devise our investment strategies? Experts predict that individual investor-preferred stocks will likely continue to perform well throughout the third quarter, as long as tariff uncertainties are not resolved. This means the current trend is expected to continue for a while. However, there's an important point. The situation could change after August. If institutional investors start flowing back into the US stock market, S&P 500 stocks that have been unfairly suppressed until now, especially large-cap tech stocks, could become very attractive investment opportunities. This means the market's balance is likely to shift back. Ultimately, the current market is creating new opportunities amidst the tug-of-war between individual and institutional investors. In the short term, it's advisable to focus on stocks preferred by individual investors, but from a long-term perspective, a wise strategy would be to keep an eye on strong large-cap stocks within the S&P 500, anticipating the return of institutional funds.